Imagine you owe someone $1 million. Not to a bank. Not to a government. To a friend. And every single month, you borrow more from that same friend just to pay the interest on what you already owe. Your friend knows you can never actually pay it back. You know you can never actually pay it back. But the arrangement keeps going. Year after year. Decade after decade. Because stopping would destroy both of you. Now scale that up. Not $1 million. Not $1 billion. Not even $1 trillion. Right now, the world is sitting on over $315 trillion in total debt. That number is so large it has stopped meaning anything to most people. And that's exactly the problem. Because when numbers stop meaning anything, the system that produced them keeps running quietly in the background. Unquestioned. Unchallengeable. Growing. This is not a story about irresponsible governments or reckless banks, though they are definitely in it. This is a story about a trap so elegantly designed that escaping it may actually be more dangerous than staying inside. Let's start with something concrete. In 2000, total global debt was around $87 trillion. By 2010, it had crossed $200 trillion. By 2024, it cleared $315 trillion. That's a nearly fourfold increase in roughly 24 years. Meanwhile, the global economy, meaning the actual stuff human beings produce and sell and buy, grew from roughly $50 trillion in 2000 to about $105 trillion today. So production roughly doubled. But debt more than tripled. You don't have to be an economist to feel that something is slightly off. For every dollar of real economic growth, the world borrowed roughly $2 it didn't have. And the pace isn't slowing down. It's accelerating. The question isn't whether this is a problem. The question is why the world keeps doing it, who it serves, and what happens when the math finally runs out of room. Here is the part most people were never taught in school. When a bank gives you a loan, it does not reach into a vault, pull out a stack of bills, and hand it to you. It types a number into a computer. That's it. The money didn't exist before the loan. The loan is what creates the money. This is called fractional reserve banking, and it has been the dominant model for how modern economies create money for over a century. Here's the consequence of that, and this is the part that should make you pause. If money is created by debt, then for money to exist in the economy, someone somewhere must be in debt. Always. In a purely debt-based monetary system, debt is not a bug. It is the feature. It is the engine. Without debt expanding, the money supply contracts. And when the money supply contracts, economies seize up. Jobs disappear. Businesses collapse. Panic spreads. So governments and central banks do the only thing they can do. They borrow more. They print more. They lower interest rates to make borrowing cheaper. And the cycle continues. Not because the people in charge are stupid. But because the system they are managing was built on an assumption that growth would always outpace debt. That assumption is now visibly under strain. Let's narrow the focus to sovereign debt. Government debt. The kind owed by countries. The United States currently carries over $34 trillion in national debt. Japan's debt-to-GDP ratio, meaning debt compared to its entire annual economic output, is above 260%. The UK, France, Italy, Canada, all running debt levels that would have been considered catastrophic by the standards of any previous generation. Now here is the uncomfortable math most politicians will never say out loud. When a government borrows money, it issues bonds. Those bonds pay interest. The larger the debt, the more interest it pays every year. The US now spends more on interest payments on its debt than it spends on the entire defense budget. Read that again. More on interest than on its military. And here is where the spiral becomes almost elegant in its cruelty. When a government needs to pay back old debt, it does not usually earn the money through taxes and pay it off. It issues new debt to cover the old debt. It is, in the most literal sense, borrowing to pay for previous borrowing. This is called debt rollover. It is legal. It is standard practice. Every major government does it. But it means that the debt never really goes away. It just gets recycled, repackaged, and slightly larger each time. At this point, a reasonable person asks a very reasonable question. Why don't governments just stop? Spend less. Tax more. Pay it down. The answer comes in two parts. One is political. One is structural. The political answer is simple and slightly depressing. Austerity, meaning cutting spending to reduce debt, is deeply unpopular. Politicians who impose it tend to lose elections. Politicians who promise more spending tend to win them. Democracy, it turns out, has a built-in incentive to spend money that doesn't quite exist yet. But the structural answer is more interesting and more alarming. Here it is. Modern economies run on consumer spending. Consumer spending runs on confidence. Confidence runs on stability. And stability, in the current system, is maintained by keeping debt cheap and widely available. The moment credit tightens significantly, consumer spending drops. Companies cut staff. Unemployment rises. Tax revenues fall. Government deficits grow. Which requires more borrowing. The medicine is also the disease. This is why central banks around the world spent over a decade after the 2008 financial crisis keeping interest rates near zero or even below zero. Not because zero rates are healthy in the long run, but because raising them risked triggering exactly the collapse they were designed to prevent. There is, technically, one way governments can reduce the real burden of debt without officially defaulting. Inflate it away. If a government owes $1 trillion today and creates enough new money that $1 trillion buys half of what it used to, then the real value of that debt has been cut in half without a single payment being missed. The creditors get paid back in full. Technically. But the money they receive is worth less than the money they lent. This is not a conspiracy theory. This is documented history. After World War II, the United States, the UK, and several European countries used a combination of inflation, financial repression, and economic growth to dramatically reduce debt burdens that had ballooned during the war. It worked. Partly because global growth was genuinely explosive in that era. But here's the catch. Inflation doesn't just quietly eat government debt. It eats savings. It eats wages. It eats the purchasing power of anyone who holds cash or fixed income. The people who get hurt the most by inflation are typically the people with the least ability to protect themselves. The middle class. Retirees. Anyone without assets. The people who benefit from inflation are typically those who hold hard assets. Real estate. Stocks. Gold. And, incidentally, the governments that owe the debt. So when you hear a central bank say it is targeting 2% inflation, what it is actually saying is that it wants to gently, continuously, and permanently reduce the real value of savings and fixed debt obligations. Every year. Without exception. By design. Now let's add another layer because the $315 trillion number isn't just governments. Roughly a third of global debt is corporate. Companies borrowing to expand, to buy back their own shares, to fund operations. Another substantial chunk is household debt. Mortgages. Car loans. Student loans. Credit cards. And this is where the picture gets quietly surreal. In many advanced economies, the cost of housing, education, and healthcare, three things considered basic necessities, has risen so dramatically relative to income over the past 30 years that the only way millions of people can access them is through debt. You cannot save enough to buy a home in most major cities anymore. You cannot pay for a 4-year university degree without borrowing in most of the developed world. Debt is not optional for large portions of the population. It has become the infrastructure of modern life. And every dollar of that debt feeds back into a financial system that profits from managing it, repackaging it, and selling it to investors looking for yield. The system doesn't just tolerate widespread debt. It depends on it. Now zoom out to a different part of the world. Developing countries. Emerging markets. Nations that were encouraged for decades by international institutions to borrow in order to develop. To build infrastructure. To industrialize. To participate in global trade. Here is what that story looked like in practice. A country like Sri Lanka, Zambia, Ghana, or Pakistan takes on large amounts of external debt, often denominated not in their own currency but in US dollars. While global interest rates are low and their economies are growing, the debt is manageable. Then one of three things happens. The US Federal Reserve raises interest rates. Global investors pull money out of risky emerging markets. The local currency collapses. Now the debt, which was denominated in dollars, becomes dramatically more expensive to service in local terms. Or commodity prices crash, eliminating the export revenues those countries were counting on to repay. Or a pandemic hits. Or a drought. Or a political crisis. And suddenly a country that was described as an economic success story 3 years ago is in default. This pattern has played out, with minor variations, dozens of times across the developing world since the 1970s. The International Monetary Fund arrives. Conditions are attached. Austerity is imposed. Social spending is cut. The population suffers. And then, often within a decade, the cycle begins again. Because the countries still need development. Development still requires capital. Capital still comes with debt. There is no exit ramp clearly marked. Let's return to the raw math for a moment. Global GDP is approximately $105 trillion per year. Global debt is approximately $315 trillion. That is a debt-to-GDP ratio of roughly 3 to 1. For every dollar the entire world earns in a year, it owes $3. Now, debt itself is not inherently catastrophic. Managed correctly, leverage accelerates growth. This is the argument that defenders of the current system make, and it is not entirely wrong. But here is the question they tend not to answer. What is the endgame? If debt must always grow faster than the economy to keep the system functioning, and if that dynamic compounds over decades, at what point does the interest on the debt exceed the productive capacity of the economy to pay it? Some economists argue we are already there in certain countries. Others argue that as long as interest rates remain manageable and growth continues, the system can sustain itself indefinitely. The problem is that both of those conditions, low rates and consistent growth, are assumptions. Not guarantees. And the last 5 years have provided a fairly pointed reminder of how quickly assumptions can collapse. A pandemic shut down the global economy. Supply chains broke. Inflation surged. Central banks, after a decade of near-zero rates, were forced to raise interest rates aggressively. And suddenly, governments that had borrowed at near-zero rates found themselves rolling over that debt at 5, 6, 7%. The interest bill grew dramatically. Not because more was borrowed. Simply because the price of existing debt changed. Here is what rarely gets said plainly. The global debt system is not designed to be paid off. It is designed to be managed. Rolled over, refinanced, inflated away, and occasionally partially written off during crises, before rebuilding again. This is not a temporary condition while we recover from some recent mistake. It is the operating model. The game is not to eliminate debt. The game is to prevent debt from growing faster than the confidence in the system that supports it. Confidence is doing an enormous amount of work in that sentence. Because the entire architecture, the bonds, the currencies, the interest rate mechanisms, all of it ultimately rests on the shared belief that the institutions managing the system are competent, legitimate, and committed. The moment that belief fractures significantly, the math becomes irrelevant. History has a name for what happens when a society loses faith in the value of its money and the sustainability of its debts. It isn't pretty. There is a quiet irony running through all of this that is worth naming. The countries that lecture others about fiscal responsibility are, in most cases, the most indebted countries on earth. The institutions that were designed to prevent financial crises have, in several documented cases, contributed to the conditions that produced them. The people who understand the system best are the same people whose wealth depends on the system continuing exactly as it is. And the voters who would need to demand fundamental change are largely the people who have been trained to view budget deficits as a household budget problem, an analogy that is, at best, deeply misleading. A household cannot print its own currency. A household cannot set the interest rate at which it borrows. A household cannot collapse the global financial system by defaulting. Governments can do all three of those things. Which is precisely why they are in a category of their own. And precisely why the rules that apply to them are different. But that understanding has never quite made it into the mainstream conversation. So what are we actually looking at here? We are looking at a global economic system that has, over the course of roughly 50 years since the US abandoned the gold standard in 1971, moved progressively further from the idea that money represents something fixed and tangible, toward the idea that money is essentially a collective agreement about the future. Debt is a claim on future productivity. The bet embedded in $315 trillion of global debt is that the future will be productive enough to honor or at least manage that claim. That bet may be correct. Or the bet may be wrong. Climate disruption may reduce agricultural productivity and displace hundreds of millions of people. Geopolitical fractures may splinter the global trade networks that underpin modern prosperity. Demographic decline in many major economies may reduce the working-age population that generates the growth needed to service the debt. Nobody knows. And that uncertainty is precisely why the question matters. In 2011, an economist named Reinhardt and an economist named Rogoff published a paper arguing that once a country's debt exceeds 90% of GDP, growth slows dramatically. The paper was later found to contain a spreadsheet error. The debate about their underlying argument continues to this day. Which is, in a way, the most honest summary of where we are. The world's most respected economists cannot agree on whether the current level of debt is a manageable feature of modern finance or a slow-moving catastrophe. What they do agree on is that the trajectory, more debt every year, faster than growth, across nearly every major economy and sector, has never been sustained indefinitely throughout history. Something always changes.